and we rapid speed down to 2,500.
Good point, wherever you reduce speed to 180.
Blackbox.
Hey gang, welcome back. Today we're going to start a series on probably, Shannon, two of the most controversial financial products in the marketplace. I don't know, there might be three, but two in the insurance world.
Yeah.
Life insurance and annuities. You say those two words, and that's what you get from most people.
Well,
here we go.
It's like, well, but we always temper it with, the A word?
Yeah,
Yeah, all right.
Yeah, everybody knows the A word. I mean, everybody and their brother in financial workshops are, pitching annuities these days.
Yeah.
And, the consumer is like really educated now, really up to speed. But we want to kind of peel the onion back and take away some of the myths or myth conceptions
Right.
and misconceptions of those two financial products, because they are super, super important in your retirement distribution phase. And that's where in our financial firm we specialize, is in that distribution phase moving into the legacy phase. Right. So we're going to do a series on it, and it's something that deserves more than just a 7-second short on YouTube,
Yeah.
or a 2-minute infomercial. We really are going to go in depth on these two financial products because they are significantly important, that if you're going to buy them and you're going to own them, how they're structured in your overall plan matters.
Yeah.
But before we go there, one of the commitments that we've made since the early days of KP's Blackbox, of Kenneth Porter and Company, and we've been doing this podcast. I started doing this podcasting stuff during COVID, and still have no clue what I'm doing. We're just putting content out there, talking to people.
Yeah, I think we put good content out, though.
But good content's coming. And one of those interviews I had was with a dear friend, Harold Underdown, who I've known for 20-plus years. You knew him at the command, Navy Special Warfare. Harold is a retired SEAL, and he and 3 other veterans started a company called 4 Branches. We had him on the show a few weeks ago, and we did this taste test right at the end.
Yeah.
And we threw this on Harold. This was not made up. It wasn't orchestrated. I just sometimes have these lame brain ideas that sometimes get me in trouble and sometimes are genius.
Yeah.
I would like to say maybe this was a genius moment, not for me, but for Harold. Because we put Harold to the taste test, and Jacob brought out 4 bottles of whiskey, and I can't say bourbon because one of them wasn't a bourbon. It was actually a scotch.
He probably picked that one out real quick.
He picked it out really quick. And so we put the sniffer and the taster to test, and I have and if you go back and watch the podcast with Harold Underdown, 4 Branches, you will see at the very end when we did this that he picked not only 4 branches correctly, but he picked the other bourbons and the scotch.
As they were. Like
as
what
they
their
were,
brand was.
and their name was. Yeah,
Oh, wow.
which was pretty amazing.
I
I got 4 branches right.
Yeah. You don't get into this industry without having a palate and,
Yeah.
being able
Are
to
they called sommeliers? Would that be like wines?
It's like the equivalent.
Yeah.
Yeah.
Harold
Like
passed the test.
Or a bourbon whiskey master.
Yeah.
I got a buddy in North Carolina that's one.
So I had this grand idea, and I'm actually glad I did it, honored to do it. But I said, Harold, you get your bourbon and you pick it out. We will promote and give a shout out to 4 Branches Bourbon for the next year. Any podcast we do, any recording that we're going to put out in front of folks, we're going to share 4 Branches if you get it right.
Cool.
Dang, he did it.
Yeah.
So I got to honor my word. I got to do what I said I would do. So Harold, Four Branches, shout out to you guys again. You guys crushed it. And if you like bourbon,
It's a good one.
really is a good one. Now, we're going to do a toast today, as we always do, honoring our vets, honoring our fallen, honoring our Gold Star families, those who have made the ultimate sacrifice, and not only those who have made the ultimate sacrifice, but those that are still serving, and your families that are serving alongside of you. A salute to all of you.
Cheers.
Now, Shorty is either drinking White Lightning
Shine. It's
or
called,
KP and Co. water.
it's called Water Shine.
We got to promote KP and Co. water.
It's kind of early for me.
The KP and Co. water is a little strong.
Yeah.
The Four Branches is tasty. If you like, throw a little shout out to Angel's Envy.
Yeah. That's a good one.
If you like Angel's Envy, and I learned this from Harold, then you should love Four Branches, because it's got one extra ingredient of wheat. I think there's 10% wheat in that bottle. And it's got a nice flavor.
Yeah.
But Shorty, honoring sobriety, he's on a sobriety kick right now.
No, I just don't want to drink.
You just don't want to drink.
No.
Whatever it is, So anyways, shout out to Four Branches.
Yeah.
Shout out to Shorty for staying true to not having anything but water.
What time is it?
9:51.
Yeah, I'm good.
You're good.
Yeah.
So good for you, man. Proud of you. All right. So another serious subject is your finances and how you get through the accumulation phase to the distribution phase.
Yeah.
And, make it through your legacy phase. And if I bring it back to Scripture, we're going to talk about bourbon, now I'm going to talk about Scripture.
Yeah.
Being a man of faith and not always living it the best, but still owning it, and it's important to me that when I go back and I look at Scripture, Scripture says, and I'm going to paraphrase here, Cody and Jacob are theologians in the studio. You guys can pull this proverb Scripture. But it talks about a man leaving an inheritance
For his children's
children.
Yeah.
And I think there's actually a song out there, Jake, for your children and your children's children. You don't make
That's
me
some
sing.
old Bible school study stuff, huh?
Yeah, it's more hip now. What's that song, Jake?
The Blessing.
Blessing. Yeah. Carrie Job.
Yep.
Yeah. So, leaving this legacy. Did I just get off on tangents sometimes?
No,
What's
I'm
wrong?
thinking about a video. I'm not even going to go down that rabbit hole.
Yeah. This thought of legacy.
Yeah.
And folks, think about it this way. If you can get through your accumulation phase, fancy word for you're saving money, you're in that phase of life where you're taking a portion of your paycheck, a portion of your wages, and you're setting it aside for your future you.
Yeah.
Right? And when you look in the financial mirror, how healthy is future you? And so helping get through that phase of having a healthy future you, there are
all the dangers that
the potholes, the risks, the journey can be tumultuous.
Right.
And we'll talk through that in this series, where we're specifically, I get that word out. We're talking about two financial products here, life insurance and annuities. Those products, Shannon, really by definition are products that are helping you transfer risk.
Right.
The risk of living too long and the risk of dying too soon. So life insurance can help you. If you die too soon, it can help those left behind continue the legacy that you would have wanted for your family had you been there.
Right.
Right? So that's the core principle of life insurance.
And having that structured correctly when we look at economic life value.
Right.
Right.
So we're going to get into that in the series, the economic life value, the human life value. Every one of us has a value. And if we were in a court system, And here's what I mean by being in a court system. Let's say there was a wrongful death suit that Shannon's, someone unintended took your life, and it was through an accident.
Mm-hmm.
What Tiffany and Arik and your other children deserve is your economic value from today until your actuarial life expectancy. So all of us have an earning potential.
Right.
So let's just say, as an example, Shannon, your earning potential over your lifetime, and this is not you, I'm just pulling
hypothetical.
a number. Hypothetical, $100,000 a year.
Yep.
Let's say that was your earning potential from now until life expectancy. And let's say life expectancy for you is 90 years old.
Yep.
So you are, 21 now?
Yeah, I wish. knowing the things I know. 43.
43.
Yeah,
So that's
60.
47 more years.
Yeah, 47
to
more
get
years.
to 90. So let's say if you could get to 90 at 100,000 a year, that's 4.7 million earning potential.
Yep.
But that earning potential isn't linear. It's indexed to inflation. $100,000 today, 47 years from now, would spend like big number.
I think 10 years is like 147,000 or something like that.
We probably should have had the calculator
That's
today.
okay.
We pull up. So this is the intro to a series that Shannon and I are going to talk through. And we're also will bring in Isaiah. Maybe we'll bring in some clients who have experienced some of these products, and we'll interview them and talk to them about their experiences with some of these financial products. And I already know there's some people who want to do that. I've had a couple of folks reach out to me and say, Kenny, why don't you talk about life insurance and annuities more on your podcast? And the conviction hit. I'm like, man, I really should, because there's so much misconceptions in the industry. Not only, Shannon, from financial professionals and experts, but also consumers. And experts mislead consumers all the time. And I was in a workshop last night. Go ahead.
Consumers also lead consumers wrong all the time.
Yeah, we get out in our front yards and we we tell people the hot stock tip.
I had a conversation with a lady the other day, and one of the things she said was, I don't like annuities. So I was like, okay, I understand. And we continued the conversation, and I brought it back, and I said, well, what is it about annuities you don't like? And it basically came down to a conversation with her friend. The person that sold the annuity to the friend didn't explain it very well, and the couple didn't know what they were in.
Yeah.
So there was fear already when you start talking about the A word.
And a transfer of ownership, owning that person's experience as if it was their own.
Right. So we debunked everything, and now she has a better understanding of what an annuity is.
And so in the future, she can make a decision, and a really good informed financial decision,
Right.
as to whether or not it would be appropriate for her to own an annuity in her retirement plan.
Yep.
And look, folks, there are plenty of annuities out there. The industry has plenty of ownership in the blame game in presenting poor financial products to the marketplace. Sometimes to the verge, I would say they were almost criminal.
Yeah.
Right? And that's a strong statement, but I've seen some financial products out there that consumers deserve to be pissed off and upset.
That have come through our doors.
We've seen it.
Yeah.
And I've experienced that in 28 years as a financial professional, of seeing all shapes and sizes of the A word of the annuity. And life insurance, you ain't getting away clean
Either, yeah.
There's a lot of financial products out there where I've seen people devastated with bad financial decisions and the life insurance picks they made.
And the cool thing is I think it's cool, is annuities and life insurance aren't a one-size-fits-all.
No.
Right?
As with anything in life.
Yeah.
One person who is appropriate for them to buy Bitcoin doesn't mean that you and I should buy Bitcoin, or vice versa.
Or should have sold it.
or should have sold it. There's secret stories to this, folks. We can tell you some horror stories. And so all of that to say is that, in life, we all have choices.
Yeah.
And we all have, kind of a decision matrix. I think of it like a tree in my mind's eye, that we go through all these branches of decision tree. Yeah. And that's where you have to narrow down, are these two products appropriate in your plan? And it's not a one size fit. It's not. I'm going to pick on Dave Ramsey. He just comes to mind. Dave Ramsey is a brilliant businessman. He's done a brilliant job of helping people over the years get out of debt.
Mm-hmm.
He did a brilliant marketing job of using a tool called Financial Peace University that back in the day was his tool for getting into churches and basically equipping the saints with financial tools to get out of debt.
Mm-hmm.
I'm going to be a little strong on Dave here and say that I think beyond that, he goes a little off track, where, telling people that they can earn 12% year in and year out is a little unintended, misleading. I get where he's saying that, and I get where that thought pattern comes from. But it's not, it's a myth conception. And so we're going to kind of break some of those out.
Did you say myth conception?
Myth, yeah.
Like bringing that
misconception.
and myth. Okay,
Yeah, the myths.
I've never heard that before.
Yeah, but I've been saying it for the last 15 minutes. We've been talking.
I just picked up on it.
You just thought I had a lisp?
I was thinking ahead about some other things to talk about while also engaging, and I missed the myth conception.
Did you guys catch that? Did you guys think I had a lisp? Come on.
We just ignore it.
You just ignore it. Myth
Good answer.
conception, misconception. I do have certain words that I say.
It works both ways.
Like second.
Yeah.
People are like, say
who?
Say what? SECOND.
Yeah.
Second. You say it.
Second.
Yeah. I say second. And people are like, what the heck is that word? It just comes off my tongue wrong.
Yeah.
I don't know. Crucify me. Anyways, so over the next few weeks, we're going to unravel the concepts and the actual truths behind insurance products and annuity products. And we're going to work through, well, what are life insurance products in the marketplace? What's available to us? And it's really broken down, Shannon, into, with life insurance, there's term insurance. Mm-hmm. And under term insurance, we have a decision tree. Do we buy yearly renewable term? So we're going to unwrap that. Do we buy a level term? Do we buy a decreasing term? Mm-hmm. And you don't see it much anymore, the increasing term. So term insurance, simply what it means, there's a term, there's a period of time. And in that term, once it's up, one of two things happens. And what are those?
Once term is up, typically you see a very, very big increase in your premium.
That's right. Either premiums are going to skyrocket.
Yeah.
To basically, we'll call it their tariff rate.
Yeah.
What they've published with the State Insurance Commission is their maximum rate that they can charge you.
Yeah. And that's the company forcing you out, right?
Right. That's saying, hey, Shorty, we want you to say uncle.
Yeah.
We want you to cancel your term insurance. So, again, revisiting that, term could be yearly renewable term, it could be level term, it could be decreasing term, which means your face amount, the death benefit that you're buying, and I actually should say renting.
Renting, yeah.
You're renting a death benefit with term insurance.
What's the max you can, I'm sure we'll get into this later, max years you can get term insurance?
For most companies, it would be 30 years.
30 years, yeah.
And that has a cutoff in age. Most people who are 55 or older.
Yeah, you're not going to get 30.
You're not getting 30 years.
Because the chance of you dying goes up.
Way up.
Way up, yeah.
Right. And we're going to bring up some software where we're going to show you actuarial tables And we're going to peel back the onion and actually educate you. So instead of just coming to you going, hey, here's this product, here's this cool feature, here's this equity index product, you can tie it to the stock market. Let's stop all the BS and just really educate consumers and then let you decide, along with your financial professional, what's appropriate and suitable for you at the phase of life you're at.
Perfect.
And I'll give you some insight. For many, many people in society, the right answer is rent it.
Mm-hmm.
Rent some term insurance. Because most people, and I'm going to say most people, that 50% of Americans actually don't even pay any income tax. And it's because they don't have enough money. We're in a society right now where the U.S. is in trouble as it relates to our low class, middle class. The middle class is shrinking. It's becoming more expensive. The dual income families are under a lot of pressure, right? And we have seen that day in and day out with folks coming through our practice, with retirees having to deal with one of the pressures is legacy shrinkage coming from their children who are not able, and I'm talking children, adult children with children, now having to go back and live with their parents and have that community support because they're not, even with two incomes, they're not making enough to make ends meet. And that is a societal issue that we got to get our hands around.
Yeah.
So for folks in that position in the world, term insurance is highly probable as a necessary tool in their plan. And I can't attribute it to an age. You might be 20 in that position. You might be 30 in that position. You might be 60 years old and still in that position. No shame. Just, hey, where are you?
Yeah.
What makes sense for you in the phase of life you're in or in the series of events that you're dealing with in your life? What makes sense? And you went back to this earlier, and I want to bring this back up again. When we think about term insurance, people will always say, Kenny, Shannon, how much should I buy? Mm-hmm. Not just the term, 10 years, 20 years, 30 years.
Yeah. What's the death benefit?
What's the death benefit? What's the right amount? And the right amount, I think there's two answers. Number one, every person should consider their human life value and what's the maximum an insurance company can issue you. That answer is typically somewhere between 15 and 30 times your current income. And that can be age-based as well, or 1 times your estate value. So an insurance company will say, well, if your estate is worth $1 million, we'll issue you, $1 million of coverage. And I'm way oversimplifying.
Do they bleed over back and forth a little bit?
They
Because
can.
if I have $1 million estate, but I make $300,000 a year and I have another 30 years, my brain goes, okay, that's $9 million plus my mill estate. I need 10.
And if a death benefit's not increasing, what's it being subject to? Inflation.
Yeah.
So the death benefit shrinks every year that it doesn't increase in value. Mm-hmm. So it becomes less and less valuable over time.
Which brings up another idea.
Which is?
Whole life insurance.
Right. So it's a whole nother product now.
Yeah.
Whole life typically means that product's going to last your entire lifetime. So we're going to unravel whole life. Now, when you hear people say whole life, they're not all the same. They're not created equal.
Yeah.
There are whole life products that can be issued from a mutual company, meaning that the old saying back in, the young people won't get this, but Prudential own a piece of the rock.
Mm-hmm. You're a part owner in the company.
You're a part owner in the company. Prudential did a fabulous commercial years and years ago, and they were like one of the tried and true mutual companies back then. Unfortunately, they demutualized, got gobbled up. Now it's a stock company. And the dividends that was paid to the policyholders is now paid to the stakeholders, stockholders
Oh, wow.
of that company.
So there was a transfer. When
That's
you
right.
leave that mutual umbrella and you go to a stock umbrella.
Now the board of directors is doing everything for the interests of who?
Themselves.
The stakeholders,
The
and the board.
stakeholders, the control, the control person.
And board members typically have a stake in that company.
Yeah.
They own, a lot of times, a lot of the stock.
Yeah.
So they're going to do everything for the interest of those that they serve, which is now not the mutual policyholder anymore.
Yeah.
It's the mutual stakeholders, those who've made an investment in the company.
But some of those companies could still pay a dividend.
That's right.
Yeah.
That's right. So we're going to unravel that. And what I'm going to really try to do is I'm going to pull the strings on some of the relationships that I have in the industry.
Mm-hmm.
And during this series, I'm going to try to get some actuaries on a call with us,
Cool.
which will be a lot of fun.
Yeah.
The most boring people in the world, we're going to make it exciting.
Math.
Sorry.
Man. All
Sorry,
math. Just
Yeah.
math.
And then I'm going to use some product developers, folks who have gone out and talked to actuaries, talked to insurance company boards, and they've actually helped design and create products. So I'm going to have some guests on the show who can speak to these products at a expert level, design level, get inside of their head and find out, why did you do this? So if you want to geek out on these products, we're going to help you do that.
We do do a really good job though of KISS. Keep it simple, Shannon. Or KISP. Keep it simple. Or no, KISK. Keep it simple, Kenny.
Yeah.
Right?
Or stupid.
Or
you know.
yeah. Keep it, yeah.
Shannon and stupid. So
But we do a good job at, if we get some people on here that are high level, we're able to break that down
yeah,
and bring it down to the consumer
right.
and, even us. I mean, it's,
Yeah. So it's going to be really important that you stay engaged in this series. How do you do that? Hit the subscribe button, hit the like button so that you're updated each time we post a new video in this series
yeah.
where we're going to go in depth on the bones, the chassis of insurance products, term insurance, whole life insurance, universal life insurance, index universal life
Yeah.
insurance, variable
Variable.
universal life insurance. And who's marketing these products? Who's talking to you about these products? What are the qualifications
Yeah.
of the people who are talking to you about these products? We're just going to lay it all out. And I'm actually going to talk to you about the C word, commissions.
Oh.
How are these people compensated? How are we compensated when we bring a product to one of our clients? We're going to lay that out. I'm going to show you exactly how that works and make it full disclosure so that you can build trust with people you want to work with.
Yeah.
And if that's us, we want to be able to tell you the full story.
Yeah.
No,
We tell every one of our clients,
hiding,
this is
no
exactly
secrets.
how we're compensated.
right.
Yeah.
You know, it's like I attribute it to the real estate industry. You know, the real estate industry just went through some big changes in their space where now consumers have more power to negotiate the commissions that they pay their real estate agents on a transaction. And there's lots more disclosures for these folks in the industry. In a lot of ways, there could have been overreach. It could have been a little excessive for the industry, but the industry also brought it on itself and brought that scrutiny because consumers weren't given choices and weren't informed. And so when that happens, that causes reform. So I think it's better we give people the truth. And truth, radical transparency, as Ray Dalio says, radical truth, as Ray says.
Mm-hmm.
That's just a great policy to have. And we can do that. It makes all of us better. It raises the bar. So that's why we're going to do a series on this, is just lay that out.
So, all right, so we're going to hit life insurance.
Mm-hmm.
And we kind of brushed over some annuity stuff.
Oh,
I'm
that's
out.
next. We're going
Yeah.
there now.
Yep. So annuities.
Yeah.
Imagine we're going to dig pretty deep because they can get confusing really quick.
Yeah, and again, the industry has done a great job of confusing consumers in the efforts of trying to sell them stuff.
Yeah.
So annuities, there's lots of different types of annuities.
Right. Same thing, fixed, variable.
At the core, the early annuity actually started that I've been able to research and find at the Roman Empire. Spartans, the special warfare troops, these guys were laying their life down for the Roman Empire. These soldiers were. And they were years of service on the battlefield. And the Roman Empire was like, man, these guys are going out keeping the empire safe, expanding the kingdom, but they're coming home beat up, tattered, torn up. How are we going to serve them and compensate them? And so one of the things the empire did is they gave them land, right? They gave them title.
Think about the movie Gladiator.
Right.
Yeah.
So they got title to land. And if you think through the U.S. now and how title works in our country, it's pretty amazing. We'll get into that a little deeper.
Minus the taxes we have to pay.
Minus the taxes, yeah. So the title, the king issued title to them to give them dominion over parts of their land. But then he said, okay, well, that's not enough because they had actually created the early currency. And they said, we're going to make sure that these guys never go hungry. We're going to give them an annuity. We're going to give them a lifetime income. It actually happened to you.
Yep.
You have an annuity at 41 years old.
I do. Kind of have two, I guess.
Got two, yeah.
Yeah.
That annuity is called a Navy pension.
Yep.
And then on the backside of that, you have a veteran's pension.
Yep.
For the crap that happened to your body, getting the crap beat up,
inside and out.
having a skull that's all screwed up.
Yeah.
And make that face again.
Yeah.
That's, yeah.
You're doing very
Super financial pro here, but man,
Yeah, we all got to screw.
you got to wear special glasses.
I do. Yeah, pull my eye back over.
Am I HIPAA violations now telling all your mouth?
I'm good. We
Okay,
just don't need
all
to go too deep, you know.
We don't need to talk about anal fissures or anything.
No, oh God, no.
I'm kidding.
I got to go back through my record. I don't see anything.
Totally kidding. But the idea here with an annuity, the one we just described to you is called a SPIA, a single premium immediate annuity.
Yeah.
So that's when you give an insurance company a lump sum, and then they pay you a series of payments. So we're going to break down the different types. And what's going on in the studio behind us in the control room? The guys are bringing up some stuff. Go ahead, throw that up on the screen.
Yeah,
guys.
we were just pulling up.
Yeah, here's what happens when we're talking out front. The guys in the back are actually fact-checking us. So they went through and found, and I don't even know what they found here, but this is the
Just
early...
a little history of annuities here.
Here we go. So the guy's actually Roman Empire. The idea of a guaranteed
Latin
income
word,
was known as annua. You know what? Save that for later. We might bring this back up in the series and talk through this timeline.
Yeah, we can overlay it too as you're talking about it, and we'll point out some things.
Very cool.
This is awesome, but at the same time, it's so frustrating for us on the other side.
Yeah.
Because if you just look at this, it has just been convoluted and added new things and just made it so confusing over the years, where now people, back to the beginning what we were talking about, are like, what the heck?
Yeah, stop right
Yeah.
here at 1759. So the concept of annuities landed in the New World, specifically in Pennsylvania. Interesting, a lot of annuity contracts come out of Pennsylvania. A lot of insurance companies come out of Pennsylvania. Where the first fixed annuity was offered to Pennsylvania Presbyterian ministers and their families. And then the payments were given to widows and orphans, a lot like Social Security. And this is where I can really go down a rabbit trail here and tell you that where I think America went off the rails a little bit is that instead of community helping community, it got pushed to big government, AKA Social Security. Like back then, the church was a cornerstone of taking care of widows and orphans, taking care of the drunkard, taking care of its community, its core community. And when you have a small community, you're like, hey, man, I hear John Doe. I hear he's struggling, Shannon. Let's go see how we can help him.
Yeah.
How can we help his wife? How can we help his children? Because, man, maybe he's got an addiction. Maybe he's got a problem that we can help. Somewhere in that, where big government tried to step in, a.k.a. Social Security.
1935, Roosevelt.
Yep. That became a problem in my mind's eye for how the society, the bureaucracy, lost its touch with community. And now we got a big Social Security problem.
Yeah.
We got a big annuity problem at the federal government
Huge.
level. So we're going to bring that back into the conversation, folks. So with annuities, there's this other early 1990s and that time, 80s and 90s, there was the advent of bringing together insurance companies and investments, brought them together. And there was a product the insurance industry created with the mutual fund industry called variable annuities. And it gave a hybrid, and that same thing happened with life insurance, by the way, variable universal life insurance, brought together investments and insurance. The transfer of risk along with the acceptance of risk.
Yeah.
And they
together
tried to
in one.
smash them together. Well, what ended up happening is that product that became a good idea in theory ended up being really, really stinky for the consumer. Really bad. And I was trying to avoid saying the shit word. There you go.
There you
Said
go.
it. So
Well, that is one of our top 5 pressures is market volatility, right?
yeah,
So when you mix the insurance with the stock market, you have volatility in
the acceptance of the risk and the transfer of risk, and
Yeah.
they're like polar opposites.
right.
It's like trying to put two opposing magnets together.
Yeah.
They don't want to stick.
No, they're pushing against each
Yeah.
other. I mean,
So
April,
the polarity.
Yeah.
Right?
April this year definitely would have upset some people in variable universal life and
So when you're
Or
thinking
UVL,
about
yeah.
these different products, Shannon, what it really comes down to is understand what you're buying,
yeah.
get an education on what you're buying. And so what we're going to attempt to do in this series is really unravel the insurance product called life insurance and the insurance product called annuities.
Yeah.
And from a single premium immediate annuity to a fixed annuity to a multi-year guarantee annuity to a variable annuity, and the one that we've seen a lot of and we, in complete transparency, use in our practice a lot, fixed index annuities.
Yep.
What are the good, the bad, the ugly in all of those products? We're going to go through a series of breaking those down for you where you can go back in our podcast and our YouTube page and break this information out for how it benefits you, and arm you with truths and validation so that when you're sitting in front of a financial advisor, you're already armed and equipped with information.
Yeah.
And we're going to do our best attempt at making sure we just lay it all out there for you and also bring some industry experts beyond ourselves into the talk and into the fold of the conversation.
So it sounds like we're arming the consumer.
I think it's great. The more information that a consumer has, the more equipped they are to make a decision when they're ready
Yep.
to make a financial decision.
Yep. Cool.
So why not do it?
Exciting.
Yeah, it really is. I'm excited to do it. I spent a number of years with my own head trash going, oh no, everybody's going to think I'm pitching an annuity or pitching a life insurance. And in full disclosure, we do use those products in our
absolutely.
financial process.
We also work in the stock market.
Right. So it's important to understand how they work and how bringing together, and we'll talk about this more, as I've alluded to, actuarial science with investments, because you need both.
Mm-hmm.
But the way that most people have tried to jam them together have been
Oil and water.
yeah, a train wreck in many instances. And so we'll talk through those. But then we're going to also talk through the successes and talk through people who have used these products appropriately in their overall plan and how that has benefited them and their family and their legacy.
Right.
So if you're interested in having more education, more information on this specific series of life insurance and annuities, the good, the bad, the ugly, stay tuned. We're going to start laying this out for you over the next few weeks. I don't have a timeline on how many series we're going to pull into this or how many episodes we're going to pull into this series. But I'm thinking right now off the top of my head, it'll probably be at least 6.
Cool.
So
Yeah,
stay
we
tuned.
can't eat the whole elephant at once.
Yeah.
Yeah.
I know I look like I've tried, but I'm working on that. Yeah. Stay tuned. Do us a favor. Subscribe. What is it? Smash the subscribe
Smash
button.
that like button, subscribe.
Yeah.
Share.
Hit the like button, whatever those terms are. Will you do that for us, please? And share our content with some friends. Please put it out there in the community for us. We're trying to grow our audience here. Shameless plug. Help us out. We love you guys. Thank you so much. See you on the other side.
See ya.
Wherever you ready, speed 180.
Blackbox.